right, we're going to finish the part 2 of this lecture. We're going to get through it as quickly as we can. Last class, we knocked out, I believe, half of it. So we're going to knock out the other half tonight. And then we'll go from there. I think we're going to close most likely. Not close. They're going to talk real estate. I think we're going to finish classes Wednesday. That's what I'm shooting for. So this class will be Wednesday. We'll start the last class maybe Thursday, possibly. Depends on how that will go. If not, I may give you a short little break, and then we come back that Monday and finish out. So I'll let you kind of know. You've got principles 2. This is principles 1. There's a second part to this principles.
Okay, let's hurry up and get this going. We have to get out of here.
Okay, well, then let me get started.
All right, thank you.
All right, so we're talking about liens. All right, now if you remember with liens are going to be those things that are actually held on the property. So if, say, Mr. Grossman, say that you got Miss Leela lent you money to buy your house, okay? Miss Leela's going to put a lien on your property and will not release that lien until you pay her off or somebody buys the house and pays her off, okay? So that's what these are coming in. Now, in regards to the different types, there are 2 main different types. There's a voluntary lien and an involuntary lien, okay? A voluntary lien is Stephen actually called the Bank of Leela and said, hey, I need to borrow some money, okay? He voluntarily asked for that money. Involuntary is, Mr. Eugene, you're the county assessor, tax assessor, and Stephen hasn't paid his taxes. So now you put a lien on his property because he failed to pay his taxes, okay? $2 million, man, he's strict over here.
I'm getting a little extra for myself.
A little bit. A little bit.
Yeah, I'm going to retirement.
So in this situation, you have the separate between voluntary and involuntary, okay? So again, like I said, voluntary, the lien holder or the lienee actually is the one that is doing the action. Involuntary is created by law. You fail to pay your taxes or anything of that nature, and it's created by law, they can put a lien on you. Okay? HOA could put a lien for non-payment. We had that discussion. Now, there also is what we call statutory and equitable liens as well. There can be certain things like a statute. You fail to pay your taxes, for example. If the statute says that they can put a lien on it, guess what? They can. Common law is judge-made law. So there could be a judge that may put a lien on it because you didn't pay a creditor. Okay? Then you have general and specific. Now, general affects all real estate property. Okay? So they can have a lien where, Miss Linda, you may have a lien against Travis because he failed to pay, he failed to pay you some money now, okay?
I like that.
Yeah, so he failed to pay you some cash. So now you got a general lien. So what happens is now you could go after either his real or personal property, okay? So you can go after both of his stuff, his house and his cars, or his personal assets, okay?
Okay.
Now a specific one is, a specific lien is where Travis now has your mortgage and he owes your mortgage and he can only go after that specific item, okay? So when you think of a loan that is held by collateral, that's a specific lien. Make sense?
More likely he'll have more of that area than I will have mine.
Now the next one is your priority of liens, okay? And your priority liens, this is where we talk about it's very, very important because it's first come, first serve. So if you happen to get 2 mortgages, okay, you get 2 mortgages. Say that Darren goes out, buys a house, and he does an 80-20 loan. He gets 2 loans, one for 80, one for 20. Well, Darren, he's got this 80-20. Well, if the 20 happens to get filed before the 80 and there's a foreclosure, most likely the full 20 is going to get paid off, but what's going to happen to the 80? It may get what's left over, and it may only be 70%. Okay, so it's very important in regards to the priority of liens is in regards to the order in which unpaid debts or obligations are paid from the sales proceeds. Okay, now real estate taxes and special assessment, of course, is going to take priority over all liens. So this is one of those good things. Is Travis, say he does not pay his tax liens, his tax his taxes on his property. Mr. Eugene, now you assess it against a tax lien against Mr. Travis, and you sell his property at a tax sale. Miss Linda holds a lien that she's put on Mr. Travis's house. If it sells at a tax sale, guess what happens to Miss Linda's lien? It's released. So that means, and this has happened before, guys and gals, it's happened where when it comes to a tax sale, it can be as little as $300 to $500 that it sells at a tax sale. And we're talking the whole property sells at a tax sale for $300 to $500. And any other liens is dispersed. It's removed. So if I buy that property, all I have to pay is you, Mr. Eugene. I don't have to pay Miss Linda. Okay? Yes, ma'am.
I don't remember what it was called or whatever, but previous, wasn't there something about that if you did go into that or whatever, is that something different about if somebody comes in and does work on the deal on the house and you did not pay for it,
Mechanics lien?
you still have to pay that?
Nope. If a tax sale comes in, it releases all liens.
So it washes
Everything is released. Okay? So it takes priority and it goes away. Now, with foreclosure, you assume everything.
Okay.
If you buy a foreclosed property, you get all the liens that go with it. Make sense? So in that situation is, yes, that's why, think about this. Is Miss Linda, if you have a lien, a mechanics lien against Travis, and Mr. Eugene's got it on the market for $300 for tax sale starting bid, are you going to be at that sale? Why are you going to be at that sale, Miss Linda?
Get my money.
Because you want to get that property so you can sell it to get your money back. What about the mortgage company that Mr. Grossman here has on Mr. Travis's property? Is he going to be there? Heck yeah, he wants his money. So in that particular situation, you're going to have a lot of people that are interested in Travis's property at that sale. So don't think that, oh, I'm going to go in and I'm going to buy Travis's property for $300. It's a bidding process. So the bidding starts at what the tax assessed value is, and then it goes up.
But what if it gets up to thousands of dollars? I mean, they only had $500 lien on it, so what happens?
Anything that's above is reimbursed back to that individual. Now, you got to understand, they subtract attorney's costs and filing fees and all that other crap that goes with it. But anything above and beyond will be reimbursed back to Travis. Does that make sense? So they are the only ones that can actually force the sale of your property for a few $100s. Think about how that sounds. $200-300. That's what I always tell people. Don't mess with the tax man or woman, okay? Because they can take your stuff. Now, of course, it's next. The Texas Workforce Commission wage liens can also be the next in line. So if the Workforce Commission has a wage lien on you, they're next in line. Okay. So basically, as you can see, governmental loans do what? They take priority. Period. Okay. Mechanics liens would then take priority from the time the work has begun or the materials have been delivered. Okay. So even if the work has not been finished, the mechanics lien already takes priority. Okay. Other outstanding liens take priority from the date of their reporting at the county clerk's office. So at the moment that you file your document, it takes priority at the time of that particular filing. Okay. The IRS tax liens do not have a specific priority. They attach to a taxpayer's equity interest in the property. So there can be times that Mr. Travis may have a tax lien, but also may owe back taxes for IRS. So the tax man gets theirs, and then boom, the IRS gets the rest. Okay. Now there is things called subordination agreements, and this is where Mr. Eugene, you have ended up. You're no longer the tax man. You're now just the mortgage company for Mr. Garrett's property. Okay, so you have a mortgage on Mr. Garrett's property. Not only do you have a mortgage, or you have your mortgage on there, but he only owes to you 50% left of the note. Well, that's $50,000. Now, Mr. Keith, he just happened to give Garrett a home equity line of credit of $80,000. Now, if we leave it as is, who's first?
Me.
You. Who's second? Keith. Okay. Now, Keith, do you want to be second if Garrett owes you $80,000?
No.
So no, he wants to be where, Mr. Eugene?
First.
He must be first because the fact is he owes the most money.
Right.
So Keith may contact you and say, Mr. Eugene, can we come to a subordination agreement where you are willing to drop to second place so I can assume first place?
I don't know. I still like what I'm at when I get.
Well,
this.
he may give you money,
Okay.
and he may tell Garrett that Garrett needs to go over and pay a certain amount to pay you to allow you to subordinate. Does that make sense?
Yeah.
Okay. So again, in these situations, subordination agreement, it allows us to change in liens. Okay. Now, real estate tax liens. Real estate tax liens in this particular situation is, like we talked about, there can be certain liens that the tax assessor takes priority. There also can be, now, you see this ad valorem? Ad valorem is just property tax. It's just a fancy word for property tax, okay? And special assessment is there can be, the tax assessor could have a certain special assessment for maybe utilities, okay? So any of these, of course, go along with those priority of liens. But of course, you always, if you have the biggest debt, it's going to be at the top, not at the bottom, okay? So again, ad valorem, of course, is for the general support or operation of the government, okay? It's calculated on the appraised value of the property, and it's according to the value. So this type of loan, and they will ask you this, what type of lien is this going to be? It's going to be a specific involuntary statutory lien because it attaches to one particular thing. Do you voluntarily choose to pay taxes? No. And is it the law that you have to pay your taxes? Yes. So it's a specific involuntary statutory lien. Makes sense. Okay. Now, the phases of the tax levy process. Of course, if they're going to do any type of particular situation, they're going to deal with the property valuation on how they end up dealing with the levy process. So they're going to value your house. Okay. After they have determined, every year they decide what your house is worth. So Mr. Keith, he has bought a brand new house. He paid $300,000, but he did not disclose it to the tax assessor. Okay, he did not, and he doesn't legally have to. He does not have to disclose it. So he buys a house for $300,000. Keith has ended up, he's got it for $300,000. Keith is like, okay, I paid for that. I'm not going to tell the tax assessor. Hopefully they'll say that my house is only worth $250,000. Well, they come back and they assess his property at $350,000. Okay. So in that situation, they have valued his property at $350,000. Now, Keith, do you want to pay an extra $50,000 in taxes on a house that you didn't actually pay $350,000 for?
Definitely not.
No, right? So Keith is going to protest his taxes. He's going to say, no. Wait a minute, Stephan. Mr. Tax Assessor here, I don't agree with that. I paid only $300,000. And what's Stephan going to end up doing? Well, Stephan's going to say this. Show me that you paid $300,000. So in that particular situation, what can end up happening?
You got sworn.
Huh?
You got sworn that.
He has to show it.
Right.
He has to show that particular situation. So the protest is where he has to now turn over his stuff and end up showing that I only paid $300,000. Okay. Now, does the tax assessor have to accept his $300,000?
Not necessarily.
No. The tax assessor could say, well, you got a good deal, but you still owe us $350,000. Okay. And I can tell you, I've done many protests in my life. And I can tell you with protest, good luck. Because they look at every little single detail of every little thing and they try to find it. They'll look over there and be like, no, this house, Travis, it's not an equivalent to the one you're in because the bathroom is 10 square feet smaller than the one that you're protesting. So this comp is 10, the bathroom, everything else is right, but the bathroom is 10 square feet. So that's why it's $20,000 more. Okay? Yeah, they come up with some crazy stuff. Okay. Now, again, we could go into this more. You can, if you can't work it out, you can appeal it. You can go and have an arbitration hearing. There's many things you can end up doing. But the key thing is that you protest. Now, there also within the tax levying processes, there is a tax rate adoption. Okay. They do adopt a certain rate. And then at that point, they begin their tax collection process. You do not want to be in their tax collection process. And if you're going to beat or try to challenge them in their tax rate collection, good luck. Okay? They do not like to be wrong. They want to be right. All right? Now, here's one little thing, a sidebar that I kind of want to tell y'all. Be very careful. Mr. Travis, for example, say Miss Linda hires you and says, I want you to probate my taxes. So Travis says, certainly, Miss Linda, I will go do that. So he goes, he runs his comps, he gets 3 SODs and 3 actives, because it's a CMA basically. He goes down to the county, to me, and in one of his SODs, Mr. Eugene, it's one of your houses that you just bought last week.
Yeah, sure it is.
So Mr. Travis comes in, he puts all the stuff down, and I say, yeah, nope, these aren't good comps, Travis. I'm sorry, we're not going to use these. Sorry, man. And Travis says, well, Miss Linda, I tried. Okay. Well, guess what happens? What am I now in a hotel right now, Mr. Eugene? What do I have in my hands now as the tax assessor?
You have all 3 of those.
I have 3 actual SOD comps with what?
What she sold
The
it for.
exact SOD amount. So when I'm going to do your taxes, what am I going to end up doing?
Sticking it to me.
Yeah, you paid this amount. Thank you. Okay. So in that situation, you got to be very careful. And let me tell you, sometimes it ain't even the real estate agents within the office. Sometimes what could have happened is you could have hired Stephen from Keller Williams, who represented you. Travis is with me, and Travis went down there. I mean, Stephen went down there and gave all that information out, and now you get screwed. Yeah. So you got to be very careful in these situations. Okay. Now, are they supposed to be using that information? No. But do they? Oh, yeah. If you remember 2 years ago, everybody's taxes, their property taxes did what? Through the roof.
$3,000 to $4,000 more.
Yep. Because the fact of the matter is they were doing what? Tracking them. Tracking them. Okay. So I tell a lot of people, you may, if all parties agree, depending on your local MLS and all of that, you got to be very careful with all of these situations. If your MLS agrees, then you need to be very, very careful in this particular situation to end up to try to make certain that when we're dealing with this, that basically you want to make certain by all means that you're going through and making sure that all of the documentation is going to be together, that everything is basically working out, that your clients are being careful in what they're providing. You got to be careful with all of these different situations because it can come back when it's coming to taxes. It can bite your client. But what I'm saying is, and I've got a little off track because he was doing something that through me. But let me get back to what I was saying. Miss Linda, you are a realtor, we'll say. You're a real estate agent. You're listing Travis's property. You might tell Travis, this is a very large purchase that you're doing. We may want to ask the seller to not actually, we agree to terminate the contract out of the MLS with the seller, so both parties agree, where this transaction is basically going to be held outside of the MLS. That's only, and I'm going to emphasize that is only if your MLS bylaws allow it. We've had issues with that before. If the listing agreement says that it has to be in the MLS, it has to be in the MLS. But if the listing agreement says it doesn't have to be in the MLS, now it can be taken out. But again, you only want to do that on very selective situations, because I have personally dealt with one where a client told me specifically, don't you dare put this in the MLS, and I don't want it in there, period. My client tells me that, I have to do what, Travis? I have to do what my client tells me, okay? And I've had situations where buyers have told the seller, or the buyer has told the seller, we won't buy this house unless you agree to amend your listing contract to remove the listing from the MLS. So again, anything can happen. Okay, anything can happen. So what is exactly the phase one? Well, property valuation, like I said, it's basically, it's an overview of what the property's worth. The tax exempt property does include property used for charity and not for profit. Okay. There are exemptions for taxable property. There's homestead, there's age 65 or older, and there's disability status. So if a client has a homestead, like we've talked before, if they are 65 or older, or if they are disabled, there are certain exceptions. They, of course, also, there will be a tax appraisal that will be done. The tax exempt property will include property that is used for charity and non-for-profit. Of course, they would be exempt, but they have to be owned by either the state, federal government, cities, hospital, educational institutions, or religious corporations. Okay. The reductions from the appraised value, again, for the taxable properties, again, these are reductions. These are not all out just clearance. These are just reductions. Is the homestead. And like we've talked before, homestead is you actually have to live and own that property. Now, I'm not saying own as 100% ownership. I'm saying you got to have some form of ownership. So if you have a lien on your property, you still own it. It's just a lien. It's a mortgage. You also must submit to a appraisal exception application form to the appraisal district. The address on the driver's license or the state issued ID and a vehicle registration receipt must actually match the address on the property for which the exemption is requested. This is very key if you're representing a buyer, because most buyers, after they leave title, guess what they do? Straight to the tax appraiser's office to file their homestead exemption. What's the problem with that? Yeah, they just moved there. They don't have their current ID, and the chance of getting your current ID takes time, so it's not instantaneous. So again, they must have this part. Now it's $25,000 off the taxable value for school taxes. $25,000 automatically dropped. Not bad. If you are 65 or older, then there's $10,000 in school taxes, in addition to your $25,000 home exception. So if you're 65 or older, guess what? You might want to go down there and file your tax exemption. Okay. There also is a tax ceiling freeze, meaning your tax rate is capped. And it is the portability of that tax freeze. So what happens is it stays on that property until basically everybody has died in that particular property. The payment of taxes is going to be in 4 installments. There is what's called the tax deferral. It's until the taxpayer moves from the home. The interest that accrues is 8% per year, and the surviving spouse does get to benefit from this homestead exemption and this old age, this age of 65 or older clause. Okay. If you're disabled, there's a $10,000 in school taxes. And I get both, though, the over 65 and the disability, though. So you can either have one or the other. Again, there's a tax ceiling freeze, the portability of the tax freeze, as well as installment payments and tax deferral. And it's totally disabled veteran or surviving spouse of a service member killed. It's 100% exemption. Ooh, not bad. Now the tax appraisal. It's the notice of the appraised value on a single family, and y'all be aware of this. Anytime you see SF, it's single family. No, single family residence homestead is due to the homeowner by April 1st. Okay, appraised at least every 3 years, and it's following a generally accepted appraisal practice. The valuation is going to be set at 100% of the market value, based on the value of a residential homestead, comparable properties sold within the last 24 months. Wonder how they get those when they're not supposed to. Similarities in location, lot size, improvements, age, conditions, amenities, views, easements. Okay. Land appraised separately. They always break down your land versus your house. That's why you always notice it's separate. And I've sometimes actually seen that. I might even saw your brothers. Sometimes the land may be worth in the house, more than the house. Okay, I've seen that many times, where the land may be 100,000 and the house is 40. Okay, it can happen.
For my brother, it was like 300,000 and then like 75,000.
Yep.
The land was sold.
Yep. So you can sometimes in that situation, you can have a big difference. The appraised value on a homestead, of course, is capped. It's going to be the lesser of most recent market value, or 110% of the preceding tax year's values plus those improvements. And again, you will get a notice of appraised value. Okay, and they will send that to you. Now, the alternative or alternate valuation methods, of course, deals with agricultural properties. Now, agricultural use valuation, they are going to be uses of agricultural value rather than the market value. So they're not looking at the market value, they're looking at the agricultural use. There's 50% of income must be from farming or ranching. Okay, so you have to use it for at least 50%. And it's going to be subject to a 3-year rollback tax if the property is sold or changed. So if, Travis, you sell your property, say it was for farming, and you end up, you sell it to Mr. Eugene for residential, they have up to a 3-year rollback taxes that they can go back and change it for payment. Okay. There also is what they call an open space valuation. It's easier to qualify for the ag use valuation. Farming does not have to be primary source of income, okay? And it is subject to a 5-year rollback tax if the use is changed. So you gotta be careful with this, because these taxes can retroactively come back and bite you. You don't want that. Now, phase 2 is they're going to present the supporting documents to the district appraiser for what's called an informal review. Okay? And you have until you have to file a written, keyword, written protest has to be filed by May 31st or within 30 days of you getting the appraisal in the mail. Okay? There will be a hearing before the appraisal review board. This is basically arbitrators. There's a board of them, between May 1st and July 20th. There will be evidence to be presented, must be shared prior to the hearing, and they may present a recent independent certified appraisal. So you may end up in a situation, you may, Mr. Eugene, hire your own appraiser to appraise the property for you to go to this hearing. Okay? If you do not agree with the appraisal review board, then they can appeal it to the district clerk or submit it to binding arbitration. Okay. Phase 3 is the tax rate adoption. It's the calculation of tax rate and property tax. It's where a certified appraisal row to each taxing unit will be provided. The taxing entity then adopts a budget. The ordinance, of course, is going to be passed to authorize what's called an appropriation. And of course, at that point, that tax will then be levied and imposed at that point once it's approved. So to figure out your calculation of your tax rate and property tax, the tax rate is computed by the money needed by the taxing entities must equal the rate divided by 100. So that dollar value of the taxable real estate is going to be classified. So here gives you a nice little breakdown. It's computing a property tax. It's the appraised value times the rate per 100 equals the tax. So if Mr. Eugene, your house is $150,000, there is a rate of $2.03. They're going to take that, divide it by every 100, and you're going to pay annually $3,058.43. Okay, I'm going to step out for just a second. Y'all review that.
Ooh, that's really nice. That's close to 6, Jim. Close to 6.
All right, so y'all should have ended up had those situations, had a chance to see it. But again, on your test, this rate right here, the $2.03, y'all need to know that. You might be able to perform this calculation on the test. Okay, they will make certain that you know that. Now, in regards to tax collection, there is payment of taxes. Okay, prior lien, January 1st of the current year, is going to be billed September through October of the current year, which means it will be due on or before January 31st of that following year. That is called arrearage. Okay, means you're paying behind, not forward. Okay, and it's postmarked on or before the due date, and you must have timely payment. If you fail to pay your payments, taxes must be valid, they will be levied properly, and again, it has to be used for legal purposes and applied equitably. Now, ad valorem tax liens, again, like we talked earlier, takes priority of all other liens. Now, they are not extinguished in a mortgage foreclosure, though. Okay? And of course, if you don't pay, then there is a delinquent tax notice that will be sent. If you do not fulfill that job and get that thing paid, then there will be a tax sale, which is basically an option or an auction. It is after the foreclosure of the tax lien in court, and it's conducted by a sheriff or constable. Okay, so don't think that when you walk into a tax sale that they're going to get up there and talk this very fast. No, they're not going to do that. Okay, they're going to end up. It's basically, all right, we got 123 Main Street. We got a starting bid of $300. Go have $300. Okay, 300. Go have 400. 400. Okay, 500. 500. It's really basic. You're not going to have an auctioneer up there. It's just the sheriff or the constable. Okay. I've even had some of them that say, "What's your max bids?" Just so that they go through it. But again, it just depends on where you're situated. Okay, but it's supposed to be in auction form. The purchaser must pay the lessor of, lesser of the delinquent tax, penalty, interest, and attorney's fees, or the appraised value. Okay. So again, as you can see here, it can get up to what, Mr. Travis? You get all the way up to what the tax district says the property's worth. And I have seen it before, where property ends up, it'll start off at $300, and after $300, next thing you know, it's up to $100,000. Okay? So in those situations, what I tell people all the time is that you have to, by this situation, you've got to end up, you've got to look at what these are. I had one guy that walked up and they were starting, it was like 300, went up to 1,500. A guy then said 5,000. Another guy said 10. Another one said 75,000. Because he knew that it was going to be everybody wanted it. Everybody wanted that property. So he just threw out $75,000. And to be surprising, it still went on. Somebody came back and said 125. And it just kept going. Okay. Now understand in this situation, you have to actually have the funds available. So once you finish bidding, you got to go pay. Does that make sense?
Does it have to be cash or money order?
It normally has to be in some verifiable funds.
Not a
So a cashier check, a cashier's check, a money order, something to that. They normally will not allow check or cash because you can fraudulently have those things, if that makes sense. No IOUs, and you normally have a very strict time frame on when. If you win it, you have a very strict window on getting the money. So if you miss it, say you get down to the bank, and Travis is your bank, and you get down there and he's gone to lunch, well, you might have lost that whole deal. Okay, and it goes on the next one. If Travis is only open from, what is it, 11:59 to 12, right? That's it. Monday through Friday.
Yep.
So you got to be there right on time.
Except for Tuesday, Thursdays, Wednesdays, and Fridays.
There you go. So again, you have to have that money. So you got to be very fast on it. And I normally, in my live sessions, I used to mandate every one of my students to go to this. They'd have to go to their local county and sit down and actually watch a tax sale. You don't have to be in, just go in there and watch it. And I used to give them extra credit for this. But because of COVID and everything else, I can't really do that. So, but again, yes, they do have the tax sale auctions, and these normally are on a Tuesday at the courthouse. Okay. Now I will tell you, Miss Leela, Enrique, or anybody that's in Houston, good luck. Okay. You go down to Harris County or you go to Montgomery County, you'll probably see easily, if not 1,000 to 2,000 people trying to fit into a room. Okay. And we're talking the room probably is like the size of one of the little courtrooms. That's it. Okay. So we're not talking a huge room. And I had one of my agents that went down there for a bid and she won, but she said you had to be screaming and all. It was like, I mean, it was a mess. It was a huge mess. So I'm assuming with COVID, everything's now outside, or they're probably not doing them. But yes, this happens a lot. Again, delinquent taxpayer does get excess proceeds. So anything above and beyond goes to the taxpayer. And the purchaser will receive a sheriff's deed, not a general warranty deed. And if you remember, it does not have as many warranties as one of the other ones does. Okay. Now, a right of redemption. Okay. There is what's called an equitable right redemption, which is the right to redeem prior to the sale. Okay. So if Travis notifies Keith that, hey, Keith, your property is about to be for a tax sale, it's going to a tax sale, Keith has up to the day of the sale to end up paying it off and getting squared away. But the moment the sale starts, it's it. And we had one time a lady, I remember years ago, the sale had already started and her property was number 10. And he had already got through 9 of them and was pulling hers up. And he said, 123 Main Street, offered at blah. And she walked in and said, whoa, I'm ready to pay, here I am. And the sheriff said, I'm sorry, ma'am, but I've already stated the address and the amount. Bidding begins. Okay? So if you're that person that's a procrastinator and you wait to the last minute, it's going to burn you. Okay? It's going to burn you. So again, you can redeem up to the sale. But if some of them classify the date of the sale, not from when you start, some of them classify it the moment they call the auction. So even if you're number 20, if they call the auction at 10 a.m. and you're at 2 o'clock, it started at 10, you can't redeem. So you have to watch how this comes into this, because you can lose your time. That's why I always tell people, if you're a procrastinator, you're lazy, you don't get stuff done, it may not get you here, but it'll bite you down the road in something, okay? So again, you got to pay the delinquent taxes, interest, court costs, and attorney's fees. These are the only things that you have to pay. That's it. Did I say anything about mortgage or anything else in here? No, I didn't. There are some statutory things, but ultimately, if Travis, you make a bid and you win it, it's yours. Do what you want, okay? But again, always, like when I'm talking about this, I always tell you, seek legal counsel if you got questions and all that. Don't go to a broker. Don't go to an agent. The best thing I can tell you, if you don't want to hire an attorney, go sit in them. Watch them. Observe. Now, I will tell you, don't think that you're going to go sit in there next to Miss Leela and be like, hey, Miss Leela, tell me all of your tricks and everything on how you bid. Because Miss Leela's going to say, excuse you, get out of my business. Okay? She ain't going to.
Really, Justin?
I love it.
Because that's the truth. I've actually done that once. When I first went to my very, very first one, I sat down next to a guy and he was getting his stuff together. I mean, he's going through his stuff. He did his due diligence. You knew he knew his stuff. And I'm sitting next to him and I was like, so which one are you bidding on? He's like, none of your business. And I was like, I'm not bidding. I'm just observing. I'm a student and I'm just observing. He's like, it's none of your business. And he got up and walked away. So again, these people,
Did he leave? If
Yeah.
that's the case, that's how you get him out the door.
Yeah.
That's how you win. You ask everybody what they're doing, and they all walk out.
I'm on it. No, thank you.
Yeah.
that would have been nice.
I'll take all of them.
But no, it ended up, there's one lady I can tell you just here in Bryan College Station. She flies in from California. Every time we have a tax sale, she flies in from California and she has a unlimited supply of money. And she gets in there and she pretty much buys every single one. That's why I stopped going. Because she walks in, and when she walks in the door, you might as well just hit the door. She's going to buy it.
50 me.
Oh no, she was one that they started off with $30,000 and they had done all of their stuff down to the penny. And she walked in and she was like, okay, that one, they'll start at $300 and she'll say $21,232. And next thing you know, nobody says nothing. And it's okay, so because she knows exactly where the break even is, where you can get to the stuff and still profit. So
Did you ever find out who she represented?
she works for some investment banker out of California. And
Oh, okay.
all she does is she flies around basically the whole country and just goes to tax sales. That's her job. So, but there was at one time, Miss Leela, and this it won't happen again, but back when 2007, 2008 happened and the economy just collapsed, there was people that was going down to Houston, to Harris County, and buying houses for $300 to $400. No joke. And so you go in, you buy a house for $300. We're not talking a crappy house. We're talking this one guy bought a house for $300,000, and it was a 2-story house in a very nice neighborhood. So
Take 200,000.
$300.
Okay, $300.
$300. I'm sorry, $300 he paid for it because that was all the taxes they owed. And he happened to just be the lucky one to get down there, and nobody was there. They started the bid, nobody was there, and he said $300, and he got it. So in that situation, now that was before tax sales were a big thing, because realtors and brokers used to keep all that hush hush. Okay. Now almost everybody knows it. You go down to a tax sale and you're going to see every Tom, Dick, and Harry that's around there. You're going to see everybody. Okay, aunts, uncles, everybody. But the key thing is that what happens, and you'll see this when you go to these tax sales. What they'll do is Stefan's sitting over here behind a computer, running numbers, and I'm at the tax sale with the headset in my phone, and with it loud enough so Stefan can hear what's going on. And Stefan, as he's hearing the bid, he's running the numbers, looking at all the stuff, and he'll say, okay, Justin, don't go more than blah. And then I'll just bid it up to my point, and then when I think that it's not worth it, I'll just step back. But what's happening is Stefan is basically running the stuff while I'm at the tax sale. So it happens a lot. And you'll see people there that they'll have sunglasses on. I mean, they take this stuff serious. They'll have their head set in, and they'll walk up and they'll be like, okay, Stefan, the tax sale's about to begin. You ready, man? Okay, you ready? All right, man. Sound good. And then, Mr. Eugene, you start the bid, and I'll try to get as close to you as I can so that he can hear everything that you're going. And so when you say, because what they do is they do it slow. So they'll say, because it's a sheriff or it's a constable, normally an older individual. And so they'll be, all right, 1, 2, 3, Main Street. Currently for sale for $300. Well, by then, you've already looked everything up, got the whole CMA ready. He's ready to go on this thing. He knows exactly what to put in there. So guess what? He's going to go over there, and he's got all the numbers, and he's going to tell me in my headset before you even start what my top dollar should be. So he may say, Justin, the max on that one's, $7,000. Okay. Then I'll just start bidding. Or you'll see some that will be like, you can tell they're newbies. It'll be me and Travis. And I'm like, okay, Travis, how much do I need to bid? Well, throw another 25. Okay, 25 more dollars. Okay, I did that and it went up 50. Okay, oh, throw another 25. 25 more dollars. And you'll see them like that. So you'll get people that are just like, it just depends, but it's a good chance, guys and gals. I had an agent that went to a tax sale and she bought a lot in, I can't remember what it's called. It was,
Livingston.
it wasn't in Livingston. It was in Willis, but it's in the country club in Willis. And she ended up buying a lot in there that was like $38,000, and she bought it for $5. Okay, so you can in some of these make money, but again, you have to be very careful, because what killed her was she bought it, she got it, but then she did not check and do her due diligence to see how much the cost to keep that property was. So while she had the lot in her name, guess what happened? She turned around, she had the property in her name, but she did not know how much the cost every year to maintain it. And another thing was that lot had to be in the country club. Well, the country club fees every month was $1,000. So she had to pay $12,000 plus the taxes and all that on it. And so in that situation is because she was just holding on to it, it burned her. Okay. You have to basically, if you buy something from tax sale, the goal is either build on it or sell it as quick as you can. Okay. Don't get like some people and hold on to it. Now, statutory redemption is the right to redeem after the sale. Now, there is a 2-year residential homestead, mineral interest, or agricultural. Okay. Now, the key thing about this, though, I want you to understand something. This is only if the property is a homestead. So you do have up to 2 years by law to redeem if it's a homestead. However, this is the exception. If, Mr. Eugene, at your sale, it ends up, we sell your property at the tax sale and I buy it and it's your residential home, well, guess what ends up happening, Mr. Eugene? I can't kick you out, because in this situation, you have a 2-year statute of limitation, or right of redemption, But this is only statutory, not right of redemption. There's 2 different types. This is not going to be an equitable, it's a statutory. Okay, so if I do buy your property and it is a homestead, then you have 2 years to redeem, but you not only have to pay what you paid, or what we basically paid, you also have to pay the price paid at the tax sale plus 25% of the purchase price. Okay, guess what? If you don't do it in the second year, so say you the first year you don't, then the second year you come in, it's the purchase or price paid at the tax sale plus 50% of the purchase price. So what do you see here? The chances of you probably redeeming are what, Mr. Eugene? Because imagine if I bought your property at $100,000. Well, the price paid at the tax sale plus 25 of the purchase price, that's $50,000. Plus, or not, well, that's at the 2 years at 50%. But in that situation is you still got to add on to the price paid at the tax sale. Okay? Now again, there's a right of redemption of 6 months for all other property, but again, the chances of somebody redeeming their property, pretty slim. Pretty slim. Unless they hit the lottery or they go to the Bank of Linda and get some money. Okay? Now there also is the special assessment tax, and this requires property owners to pay for improvements that are benefiting their properties. Okay? So like a road, maybe a new road, or maybe new goalies or things to that nature being installed. These are going to basically pay for the improvements benefiting the property. They of course are going to be due and payable in equal annual installments. And it's normally over about a 5 to 10 year period, but with interest. Again, these are specific. They could be voluntary or involuntary, but they're also statutory liens. Again, the utility district tax, of course, is going to be, this is what we call a MUD tax. It's to provide water, sewer, or drainage and or flood control. They're generally outside a town or city. The utility district created by a developer, and the utilities paid for by bonds. Bonds also retired by taxes, and the statutory notice to the buyer required before the final execution of a sales contract. Now, other liens that can be also provided could be mortgage liens, which we all understand. A mechanics lien we've talked about. A judgment lien, that's a little different one. I want to add a minute there on this one. This is that point, say that Garrett doesn't pay me my money. He doesn't pay. I gave him some money on a credit card. He didn't pay me back. He charged up $10,000. He didn't pay me. So I go to Honorable Judge Travis, and I say, Honorable Judge Travis, Garrett racked up $10,000 and didn't pay me back. I want a judgment to go after Garrett. Well, he gives me a judgment because he didn't pay. Guess what happens? I take that judgment lien and do what? I file that judgment lien where? With the county on that property, and I can try to take it. Okay. Now, if I file a judgment and he tries to sell his property, I may not force the sale, but the minute he sells his property, what happens? I get paid. Okay. There also can be an estate inheritance tax lien. There can also be what's called a vendor or vendee's lien. Okay, these are different types that you can know or need to know about. There's also what's called a surety bail bond lien. You get a bail bonds, you're going to have to, they're going to put a lien on your property. Okay. TWC, Texas Workforce Commission wage lien. Of course, an IRS tax lien, a federal judgment lien, or the UCC lien. Okay. There's many different types of liens that can be filed against your property. Now, of course, the deed of trust lien is going to be the basic, most common one. It's your lien on real estate. Okay, so it's given to the lender by a borrower as security for the repayment of a loan. It also discharges the debts in bankruptcy, but does not eliminate the mortgage lien. So if you file bankruptcy, guess what? Your mortgage don't go away. You don't get to go out, Mr. Eugene, and get $1 million loan to buy a house, and then after you move in, say, oh, bankrupt.
Yep.
I get to keep the house.
Yep.
Nope, don't work like that. Nope. It's also a voluntary specific lien. Okay. A mechanics lien, of course, is an enhancement of value theory, meaning you're doing this, you hired Travis to put a pool in, Mr. Eugene, because you're wanting to enhance the value of your property. Okay. So it's available to purchase or persons or companies that perform labor or furnish materials. The priority is established from time to time, and the labor performed or materials delivered, and there is no right of redemption after foreclosure on a mechanics lien. Okay. Again, an affidavit claiming a mechanics lien is going to again be specific and involuntarily. Again, the lien filed when the general contractor is not paid by the owner, or the subcontractor is not paid by the general contractor. So if Darren was to do some work, say, Travis, you were the general contractor, and Mr. Eugene wants you to put a pool in, and you hire Darren, and Darren, you get the money from Mr. Eugene, but Darren don't get his money as a subcontractor. Darren can come and end up filing a lien against you, Mr. Eugene.
But I paid it all to him.
Well, he
I
didn't
got
pay.
screwed.
Darren got screwed. Travis took that money and left.
He got all the money.
Yeah, Travis took it all and
I gotta
left.
pay more.
Yep.
Well,
Yep.
can I sue Travis?
You could.
I'm
But
in
he's
Bahamas.
gone by now.
Yeah,
He's in Bahamas.
Yeah, he's
Well,
gone.
I got a house down there.
I'm down in St. Croix on the Virgin Islands.
Yeah, he's on the Virgin Islands relaxing with your money. So again, enforcement, foreclosure suit, and again, there could be a sheriff's sale. So yes, you could pay Travis. He could deuce out of here, and Darren can still come after you for his money. And he could file foreclosure and force the sale even though you paid your bill. Sound fun, don't it?
When I get to work at.
Yeah. Or get it from a very reputable company that's not going to up and leave. You know what I'm saying? Again, it is a specific voluntary matter. Again, it must have a contract with the owner, and it's signed by husband and wife if it's the homestead. It's signed no earlier than 5 days after the loan application, and it may be rescinded up to 3 days after signing. But it must be signed at a third-party office, and the enforcement would be a non-judicial foreclosure. Okay. There is certain homeowner protections. If final bills paid was filed, an affidavit stating that you paid everything, The chances of the sale might not happen. Always use the might because you don't know. Contractor may be required to have an escrow account. And there can be 10% retainage, which is a 30 days after completion of work. There are some protections, but again, always, 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 if your client asks you, well, should I do this or whatever, talk to an attorney. Always talk to an attorney. Do not give legal advice. Okay. Again, we talked about judgment lien. It's where a court declares a debt, which is most likely a money judgment. The county clerk prepares abstract of the judgment, and the county clerk certifies and records that abstract of judgment. Okay. You don't pay your credit cards, they can go get a judgment lien. Now, if you have a homestead, the chances is it's not going to attach generally. Okay. I'm not going to say all the time, just like with anything else I teach in here, never say all the time. Never say all the time. Generally, it might. Priority is from the date of the filing with the county clerk, and it must be recorded in all counties where the debtor owns property. So if Mr. Eugene, if you have 10 properties, okay, he's got 10 properties all over the state of Texas, and I get it in Brazos County, I have to still go file them in those 10 different counties. Okay, I still have a duty to get them filed so that I can attach to his properties. If it's not paid, the creditor can obtain a writ of execution. And years ago, I used to actually deal with writs of execution. Those of you that know me, I have my PI and process server and all that other stuff. But years and years ago, when I worked in the law firm, we used to actually get writs of executions. And what it does is it directs a sheriff to seize or sell non-exempt real or personal property. So while if Travis, say you got a lien against Miss Linda finally for all that money she owes you, okay, you finally got a lien, okay, a judgment lien.
Wow.
So now he's got that lien for $200 million, okay? Yeah, Miss Linda's been racking it up a little bit. Yeah.
This is not right. I
So-
step in a hornet's nest
Yeah.
now,
How do you think I feel? I need to pay.
and I haven't gotten paid either, so we're even.
But what happens is Miss Linda's got that writ of execution, or well, Mr. Travis, you got that writ. Well, it directs me as a sheriff to come out to Miss Linda's property, and I can actually seize or sell off any non-exempt property. So if Miss Linda happens to have 10 cars and she's not married, well, guess what, Travis? You can take all her cars and sell every one of them where she only has one. Okay? So in that particular situation, it directs the sheriff to go out and take stuff that's not exempt and sell it so that she can pay you off. Okay. And another thing you got to be careful with in judgment liens is that if you own a business, they can post a police officer at your door in your business.
Yep.
And anytime somebody walks in with cash, the police officer says, ma'am, are you making a payment? Yes, give me that. And they can take it. Okay. So if you run a business, they can, in some situations, not only take payments, but they can also go in and take furniture or things that are not exempt. So that makes sense. Okay. Now, again, when a debtor pays, he will get a release. It's just like anything else. You pay off your debt, you get a release. The abstract of judgment lien is going to be valid for 10 years, and it can be extended under certain circumstances. 90% of the time, you got a lien, they're going to let it renew. So it's renewable every 10 years. Okay? So you're going to get that money. You may not get it right this moment, but you're going to get it. Okay? It is going to be a general, which means what? It can attach to anything. Involuntary statutory lien. Now, there are exemptions, Mr. Eugene, if you're married up to $60,000 for the family. And if you're single, up to $30,000. Okay? Some of the items that are exempt property is your Bible.
Good.
They cannot take your Bible. Your home furnishings, your food, your tools, equipment, books used for your business. They can't take all your clothing. Sorry, Travis, you can't take the clothing. I know you might have wanted that, but you can't take it. Motor vehicle for each adult with a driver's license. So that means, say, Miss Leela has herself, her husband, and 2 children, and they all have driver's license. They can have up to 4 cars. Your pets. Unfortunately, Travis, you can't come get Holly. Sorry, man.
She's not for sale.
This isn't a sale, this is me taking your stuff.
Well, you ain't getting that either.
So again, in those situations, these are things, but again, here's the key. Here's the key. For how much is it exempt to? Up to $30,000 if you're single, or $60,000 if you're married. Okay. Now there are some exceptions, and again, don't always go with what I'm teaching you. You go talk to an attorney because everything is what? Case by case. Everything changes, but this is just some of the basics. An attachment, of course, is to prevent a debtor from conveying title to unsecured real estate. What happens most of the time is if Travis serves me with paperwork, for example, what do most people do if they know that they're about to lose a lawsuit? What do they do? Start shifting the money and moving things and hiding and changing it out of stuff. If you do anything from when a lawsuit's filed, guess what happens? They can come back and retroactively undo that sale. Okay, so to prevent a debtor from conveying title to an unsecured real estate, they can attach to certain things. The court will retain custody of the property until the suit is concluded. Now it's called a lis pendens case, which is litigation pending, and it's the notice of a possible future lien. So they can file a thing that says, whoa, 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 nothing can happen. Nothing can happen because there might be a future lien. So no transfers can happen. And it's filed with the county clerk. The priority for a later lien would be at the date that the lis pendens and indexing of the public record. Okay. A vendor's lien, of course, is it secured a seller or lender, and it is a specific involuntary equitable lien. A vendee's lien is secured by a buyer as in a contract for deed. Okay, if you remember that, that's where you're buying the deed. And again, it is specific involuntary equitable lien. There also is the estate and inheritance tax liens, which is encumbered by deceased person's real and personal property, either general, involuntary, or statutory lien. The bail bond lien, again, they will oftentimes use real estate as surety for that bail. This is only for non-homesteaded property. So if you want to get somebody out of jail and you have a homestead, probably not going to be able to get that bail lien on your property. Okay? And again, it is a specific voluntary lien. A TWC, Texas Workforce Commission lien, can be against an employer who owes back wages. Not the employee, but the employer. It has super priority status, meaning that priority is above all liens except ad valorem tax liens and special assessment. They should not attach to homestead, and again, these are general involuntary liens. There is the IRS tax lien, which is non-payment of federal IRS taxes. It's on taxpayers' equity in all real and personal property, and it's a general involuntary statutory lien. There's also a federal judgment lien. Again, the lien is in favor of the federal government. So things such as school loans, foreclosure on an FHA or VA, and again, these are effective for up to 20 years. And again, these are also general involuntary liens. They can also have the UCC lien, which is a pledge for personal property or fixtures. These are secured by a loan or credit purchase. The security agreement is going to describe all items to be included in the lien. And the financing statement is going to be the notice of the security agreement that involves legal description. And it must be reported with county clerk. Okay? All right. Now, what I want to state in this situation, I want everybody to be aware of this, is understand that with these individual liens, with all of these different things, it is imperative that you have an understanding in regards to how this all processes. All of these liens can go on a property. Now, why in the world do you need to know all of these different liens? Well, here's the reason why. When they do a title search, title is not just going to search, does Travis own this property? No, title searching everything they can possibly find about Travis. Everything. They're trying to find anything they can. So when your client, Stephen, may go to Travis and say, Travis, you know, you want to sell your house. Yeah, I want to sell my house. Okay. Is there any liens that are against you? No, I don't have nothing, just my mortgage. Nothing else. Nope, nothing else. Are you certain? Yeah, I'm certain. Okay. Well, when you go file that paperwork to Miss Linda, we all know how Miss Linda is up here, those of y'all at work. What happens, Travis? She does what? Goes through it all, right?
Yeah.
Everywhere. Pin picking every little thing, right? That's what happens with title. They sit down and they look at every single little tiny thing. Okay? So in that particular situation is, you're going to sometimes see all these liens pop up. Now, Stephen, question for you, because you had this issue. Is everything title fine? Is it always correct?
No.
No. So they may say that Miss Leela has $150,000 in back child support. Okay? But does Miss Leela actually have $150,000 in back child support?
No.
No. It's just her name is a common name, we could say, in that hypothetical. And because of that, it may be another Leela that ended up, and she is the one. But they're going to flag it on your client. Why? Because what's your client trying to do? Trying to make a sale or buy a house. Okay, most likely it's a sale. They're trying to make a sale. So in that particular situation, they don't want Leela to be able to sell the house if she owes that child support money. Okay? Or if Miss Linda didn't pay her taxes. Miss Linda, you know, there's how many, 4 or 5 Lindas? Yeah, 5. There's 5 Lindas. So, and that's just in one town. There's 5 Linda Nobles. So in that particular situation is, if she's selling a house, if any one of those Linda Nobles is owed money, guess what they're going to end up doing? They're going to flag it. Okay, they're going to flag it. So the reason you need to know about all these is it teaches and it helps you understand, or your client understand, exactly where you're coming from. Why are we needing this? Don't let your client freak out just because it says that they found child support or there's an IRS. They're going to look at everybody. Does that make sense? Okay. All right. So, Stephen, go ahead and stop our recording.